What's going on, everybody? Welcome to a Capital Hungry market analysis webinar, as well as a New York scalping session. So we were just continuing from last week's market update, where we were still looking to extend very similar trade ideas across the board. We can see primarily GJ still had some pretty nice continued upside movement, sticking to the buyer bias and still playing yen weakness. Well, on our dollar pairs, we're still just having some pullbacks or some ranging, as the main focus point is a US CPI report tomorrow. So I wouldn't be surprised at all to continue to see dollar pairs ranging, having that indecision on equities, and that can probably hold the most weight until, of course, tomorrow, with CPI being the main deciding factor, whether we see the narrative of dollar domination come back into the scene full force, and of course, the market pricing in the tightening of financial conditions of the Fed, or will we still have another declining or within expectations inflation report that will still feed the Fed pivot narrative? So we didn't get that much significant movement on gold. GBPUSD is just doing a bit of a pullback, setting up potentially that weekly upper wick, and can even come in these double top areas. EURUSD, just a minor pullback from these lows. USDCAD still in a very large intraday range. US 30 still in a very large intraday range. And it was only GJ that continued the buyer analysis with some very clean, healthy volume from Asian session all the way to even this current minute right now. So in terms of market analysis and trade ideas, let's go through that first across the board, and also just some minor projections of what we expect with CPI. And then we'll look for some scalps here, which more than likely will just focus on gold and GJ for the scalps today, as GJ has some pretty healthy volume to start the week on that yen weakness. And compared to the dollar pairs, more than likely gold will give us a quick squeeze with the scalp if we do get some healthier volume there and still have dollar domination holding the most weight just into this session before CPI. Now, I wanted to share something very interesting here on gold when we zoom out. It's not exactly the same, but it's still quite interesting in my opinion. So here you can see we obviously had some pretty solid bullish market structure during this period of time, and especially as we started 2023, as the Fed pivot narrative was holding the most weight. The Fed pivot narrative was holding the most weight as we had multiple catalysts during that time period supporting that narrative. One coming from setting up order flow for the end of the fiscal year in the new year, and also keeping consumer morale and overall stock market optimism up into, of course, the holidays to close off the year. That was 2022. Another was also having economic data reports that supported the markets getting a bit ahead of the curve on the Fed's potentially pivoting. And that was one, either having declining inflation reports, which shows that the Fed's front loading of rate hikes and tightening of financial conditions is doing its job, and they can potentially start to reverse from that path. Or two, having economic data that's deeper in recessionary scare ranges, which shows that the economy cannot handle tightening of financial conditions. So the Fed should pivot for that reason, right? It was either the Fed should pivot because inflation's improving, or the Fed should pivot because the economy can't handle the tightening of financial conditions. But anyways, what's more interesting than that is we're at a very similar price point coming to this next CPI report, obviously February 14th this week, compared to this CPI report here into the start of 2023. So as we were trending bullish here and we had this previous high printed, and we're also still maintaining bullish market structure at that time. Oops, did not mean to delete that. But anyways, just a rough idea, bullish market structure at that time. So, of course, at that time, as the Fed pivot narrative was holding the most weight and having various fundamental catalysts that were supporting that narrative, lining up with the end of the year market timing and setting up order flow for the new year, you can see we primarily just had buyers printing these higher highs and, of course, extending higher. Here, in this very specific situation, we can mark it out in a different color. You can see as we break above this high for a period of time during this week, prior to the inflation report, we were just primarily consolidating, right? You can even see we started to break a bit out from the consolidation zone, but within that report period, but initially had this heavy liquidity grab that took place almost into the range lows, almost revisiting the previous highs before finally starting to get a breakout, new intraday highs printed, and continuation move here that followed. Right. And you can even say that that pretty much held weight into continuing into the next set of higher highs and holding that trend for a significant period of time. Right. Now, what's extremely, extremely interesting to me is as we've peaked that very, very key higher time frame liquidity zone identified in the 1860s, we've also had fundamental catalysts going against this. That's been shifting this sentiment, starting to create some stronger bearish structure. And in the inverse here, we broke out of this consolidation zone and at very similar price points where we had an accumulation phase in the last CPI report as well. Now, our predictions during this period, as it was still early into the new year, as we could still potentially go 50-50 with CPI, meaning it could easily still be declining for another month or potentially starting to show some increases, as my prediction from a macro perspective was starting to look at inflation increases come January, February of 2023, right? But that report was still declining, showing improvements and feeding into Fed pivot prayers. So it respected more of the bullish structure and had a liquidity grab to the downside of this order block area before starting to form and continue further bullish, right? In this situation, I would not be surprised at all, and it would not be breaking structure if you could get retests on the inverse side to come and retest the order block highs instead of the order block or range lows and around this price sensitivity area, then turning a lot more bearish with a high CPI report or starting to see something like that occur, right? Tomorrow, high CPI prediction. So what I'm trying to explain is if we get a high CPI prediction tomorrow, whether in essence you were trending bullish and fundamentally bullish, or trending bearish and fundamentally bearish, we're at a very key liquidity zone and very key price point of interest to get orders generated in a similar price point, but going in the opposite direction because you have opposite impact from the fundamentals in play. Now, instead of having bad economic data reports, labor market weakening, CPI were showing a bit of a decline. Now, as we peak this major sell side liquidity zone, set up order flow for the new year, started to get a shift in the sentiment due to data reports coming out extremely optimistic with the NFP and potential predictions that CPI is going to be high tomorrow. A high CPI report would be killing pivot prayers, bringing back dollar domination. And it's very common with NFP reports, CPI, FOMC, that even if you have one directional data, you can still get heavy liquidity grabs before continuing in that trend, setting up order flow from better price points of interest. In this situation, the liquidity grab occurred to the downside to generate more buy orders coming into the order block low and roughly retest of previous highs as that CPI report was declining, feeding into Fed pivot prayers, aka the impact was more dollar bears, gold bulls, and stock market bulls at that time. But now, as we're starting to shift into bearish structure and have expectations of data feeding more into the dollar domination narrative, we've already had some very, very optimistic labor market report, more hawkish Fed speakers just further cementing the fight on inflation, not bringing anything new to the table, but also not talking about rate cuts or stopping rate hikes or stopping the fight on inflation either, and potential expectations where we understand how inflation moves, that it does not just move in a linear path, that it can easily move over a period of months in episodes and in waves. So with wages still surging, commodities still being at high prices, a lot of these other asset classes like the stock market, real estate still being at high prices, regular basket of goods for consumers when they go put gas at the pump or they go pay for their groceries at checkout still being relatively high, I would not be surprised at all to see that this inflation report tomorrow is a lot higher than expected and edging back to the upside, leading to an inverse impact here of, instead of a liquidity grab down, a liquidity grab up to generate more sell side orders and then flipping bearish. Now, what's something we have to update on and include is the Bureau of Labor Statistics updating their expectations and even updating some of the data from the previous months, which a great breakdown of that was given by Nalab in his recent economic report. That's obviously been sent to the main feed yesterday. So make sure you check that out, right? We can actually even go through it right now if you guys want to. Before we go through that, can I clear the screen here? Is that not very interesting, by the way? All right. This was a consolidation on the buyer side, accumulation of order flow, and the last, not the last CPI report. Actually, yeah, the last CPI report, but when it was feeding into the Fed pivot prayers, it was still declining. And the Feds and the markets hoping the Feds pivot so they can keep pumping up the stock market. Hence, during this time, dollar went a little bit more bearish. And of course, stock market went a bit more bullish. Now, we're in that same type of liquidity zone in price point of interest, except with more bearish incentive and fundamental catalysts, where if the CPI report tomorrow is increasing, showing that the fight on inflation is nowhere near complete, showing that the Feds are still far away from their 2% macro goal, showing that inflation is still moving in waves, instead of getting a bearish downside move first in liquidity grab before collecting more buy orders to continue up, we can expect more of the inverse impact here and conveniently at pretty similar price points. That's also a great point, CJ. And what I wanted to include is not just because of market psychology. That's a great point. it takes a lot more for the stock market to be bearish than it does bullish. But another reason why I wanted to include that it might be a less aggressive of an impulsive drop here, both on gold and the stock market, and dollar might not see as much impulsive upside, is because the expectations have also been adjusted. The forecasts have been adjusted. Prior to the labor market report and like NFP last week and stuff like that, and prior to the Feds coming into play, like even Jay Powell's little mini interview and some of the more Fed speakers, this CPI report on the monthly was actually expected to show another decline. But now that's been adjusted where it's expected to show a bit of an increase. And even some of the previous ones were expected to show a bit of an increase, and that's been revised and adjusted accordingly, right? So I can see that if the CPI now, the forecast has been adjusted and it's a little bit closer to forecast and still showing an increase, that it may not have as large of an impact compared to the upside here. We may still see an aggressive liquidity grab. We may still come down to these same lows, but maybe then the next daily candle will drive down into like the 1840s, 1830s. I sent a little picture as well, which we can look at, and we'll look at that report in the lab sent. So this was something that I shared before, just talking about market psychology and understanding the impact. So this is just a little visual example of pretty much what CJ's talking about in his comment there. It takes way less in terms of catalysts to support the stock market narrative of greed versus the Fed narrative of bringing down inflation, which will lead to an inevitable bear market on equities. The Feds have no choice to continue to combat inflation. Otherwise, if inflation becomes entrenched, continues to rise to high risk levels, it can start to spiral out of control to hyperinflation in a very, very short, volatile period of time. And once inflation is starting to go out of control into hyperinflation, that's a whole completely different beast compared to inflation sitting at 7 or 10% or bouncing around from those levels, right? But the stock market buyers, the corporations, the commodity buyers, and so forth, they don't want to let go of that investing environment that made making money for them so easy through the pandemic. What was that investing environment? That was very low rates by the central bank, money, increasing money supply and pumping it into the markets, institutions and corporations taking out loans with minimal debt required on it, and then investing those loans back into their business or mainly back into the markets, gaining profits on that, and that cycle continuing through the pandemic, of course, right? They don't want to let that go. They want to continue to pump the stock market. They want to continue to extend their wealth. They don't give a shit or see the risks of inflation because it's not as close hitting to them compared to the regular day-to-day consumer or day-to-day worker. You think these billionaires and multimillionaires and corporate leaders and executives care about egg prices or gas prices? Of course they don't, right? They don't give a shit. But anyways, it takes way less in terms of catalysts to support the stock market narrative of greed versus the Fed narrative bringing down inflation. And the stock market narrative of greed was also created by the Feds and central banks as well, as an excuse to help the economies during the pandemic, right? Remember the pandemic? A quick little side note here. We're at the start of it for this virus that has a 99% survival rate. On the media, they were showing like freaking dead bodies on the streets, people walking around in hazmat suits and disinfecting the streets, people in New York shoveling up garbage bags of bodies. Like the fear and propaganda was absolutely insane, right? It was crazy. And it worked. The masses got extremely scared. People were locked down to their homes. People were given a small experiment of solitary confinement. Solitary confinement is given to the worst of the worst criminals that do not comply and follow the rules of the prison system, right? They're causing more issues. They're being too violent. They're causing more problems for the people in control, right? So, yeah, right? They had dead bodies on the street, piled up garbage bags, and these mans walking around in full suits, like disinfecting the streets with those spray guns. Remember that shit? It's crazy. It's bullshit. It was all bullshit. It was all media propaganda. Now, side note, remember this, they're going to do this same type of media fear mongering with these identified flying objects and, of course, aliens or terrorist threats. They're going to create a lot of mystery and confusion. Trust me, watch it. Watch how it continues to expand and grow, right? But anyways, so during that period of time when the world was extremely locked down, scared, being forced to the confinements of their home, not allowed to go to the gym, not allowed to see your grandma, or you might kill her with a hug. Stupid shit, right? Not allowed to do any of that. As the world was trapped and locked down, trillions of dollars were being pushed into the markets and made into the markets, right? We've done enough educational webinars on that. But those greedy stock market buyers, they don't want to let that era go. They don't want to let that extremely favorable investing environment go. Low interest rates, money pumping, asset purchase program, all the whales riding that wave, all these asset classes exploding in value. Let's think about this very logically, right? As the world was locked down, as you weren't allowed to visit your family members, as you weren't allowed to go to the gym, as you were seeing all this fear mongering regarding COVID and bodies laying in the street and like freaking like a zombie apocalypse on the news, right? As you were being forced to take 5 or 6 vaccine shots, the markets went from a crash point, not back to the pre-pandemic highs, but to new record-breaking all-time highs never seen before in history. Can everybody sit down and absorb that for a second and tell me like how the rich don't take advantage of opportunities, or how you can't speculate that they create these crises on purpose, distract the masses, milk them, make them further comply and scared, and then they just milk everything behind the scenes? As you were locked down, not even allowed to go to your gym unless you showed an identification that showed you got a needle 3 times. Stock markets went to record all-time highs, and you weren't involved in that. Your dad wasn't involved in that. Maybe, I'm just saying, like in generalizations, like your grandparents and parents weren't involved in that. They were in fear-mongering mode. They were scared. Insane, right? But anyways, so this is just a visual example that we've had all these major events from the central bank of tapering, rate hikes, dollar domination, bringing down high inflation. And it's held less weight than simple rumors of the Fed pivoting, because Fed pivot narrative supports the stock market greed and, of course, keeps dollar softer as well on a global scale. But anyways, very interesting there. And before we just jump into that, so this is just what I wanted to quickly highlight on. Obviously, you already have access to this report. The lab wrote it up yesterday and we sent it to the main feed. So the BLS, the Bureau of Labor Statistics within the US, released revisions to the CPI report, which originally showed a negative 0.1% month over month reading. With the revisions, we actually saw that inflation rose 0.1% rather than dropping by 0.1%, right? Further, CPI data from November was also revised higher to 0.2% versus the original of 0.1%. To the general public, these revisions that come after the fact, this manipulation of data to potentially support a market narrative, we even expected that we might not see high inflation reports until December, January, January, February coming this year, as it would be reflecting December and January, right? We even said that. And the reason for this was it made a lot of sense to create market and price stability across the board. If you just had high CPI reports in November and December that followed, one, stock market wouldn't have done this relief rally. Two, stock market would have been having downside from 30K and potentially breaking back below pre-pandemic highs right towards the North American holidays and right towards the end of the fiscal year. The main reason we had this relief rally and we're consolidating at these highs now with indecision was having declining inflation reports that have now been revised to show, actually, you know what? November and December weren't declining. We just went back and checked the formulas. We just went back and did a few revisions. Actually, inflation in November and December was still rising. If that truth was brought out back then, right into the holidays, the stock market would have been melting. Right into the new year, we would have been going to melt and print some new lows. Instead, right towards the end of the holidays, right towards the end of the fiscal year, setting up order flow for the new business year, we had this relief rally and also a pullback on the dollar, creating price, market, and economic stability. Because remember, it's not just the stock market buyers wanting upside that the interest rate hikes by the Feds were preventing and creating this bear market. The aggressive rate hike cycle by the Feds was also heavily appreciating, like heavily increasing the value, right, of dollar. And dollar exploding in value at a fast rate, volatile upside, was having very negative effect on emerging countries and smaller countries and their debt obligations that are denominated in the dollar, right? And of course, having an effect on other major countries' currency value against the dollar, as still majority of global business is done in the dollar, is denominated, exchanged in the dollar, right? It's still your world reserve currency and business currency. It's still considered the petrodollar and linked to oil, import and export as well. So that relief rally coming to these major liquidity zones that we identified, all it's doing now is that if we have high CPI reports or the Feds bring back the pressure with the high CPI reports, is we're just going to be trending back down to price points the market's already seen before and been adjusted to. And on the inverse of the dollar, we're just going to be trending back up to price points on the dollar that's already been seen before and the globe's already been adjusted to. Does that make sense to everybody? Because remember, right when we started to have the relief rally as well and some optimism was not random as well in terms of the price point. Right towards the end of the business year, coming towards US holidays, which a lot of people keep saying, gee, you keep talking about the holidays. No, man, that's a major important time period, not just in US, in Europe as well, right? It's a period of time where you want to keep consumer activity, consumer morale, you want to keep it high. It's a period of time where you don't want to have mass panic in the stock markets or in economies, right? It's a period of time where you normally see huge surges in consumer activity, and it sets up prices and leads into the next year. So as we're approaching pre-pandemic highs, we started to have that relief rally, which was induced by, at that time, they told us declining inflation reports, right? And now think about this. Now the BLS has come and said, actually, we just made some revisions. November CPI was actually higher, and December CPI was actually higher. The monthly was actually increasing still. Crazy, right? So anyways, Nalab did a great job explaining that and breaking it down so we can quickly, because the masses will never be high IQ enough or aware enough to understand that these inflation reports drive major market moves, or that there's billions of dollars being made on this information, or how it impacts their cost of goods or prices to come down the line. They'll never be high IQ enough, and then they'll never band together to actually fight about these things, right? This is simply some digits on some statistics being edited really behind the scenes. Yes, BLS releases this report, but so does the Fed release their monetary policy every month. How many of your parents go check out the interest rate policy? Not many, right? How many of your friends and family check out what's going on with the Fed policies every month, or with your respective central bank policy? Probably nobody in your families or friendship circles, right? Yeah, so who's going to be checking out this Bureau of Labor Statistics? This guy said, man, him around me, check Instagram thirst traps. But anyways, Mr. Singh, that's a good claim to make, but also understand when you're coming out of the holiday season, a lot of the seasonal jobs are already adjusted, right? You're also having a lot of people going back to work, and the layoffs in focus that was in the mainstream media was just talking about tech sector. And a lot of the layoffs have been purely within the tech sector, which is what they're advertising and showing in media. Like you'll see like Amazon laid off 5,000 employees, or Apple's looking to lay off another 2,000 employees, or HP's looking to lay off another 2,000 employees. But the majority of other sectors within the economy, especially ever since the end of the lockdown phase, has been very, very quite busy, right? So January is not really considered a quiet month. The start of the new business year can be very busy. And a lot of these sectors, from the service sector to manufacturing to pharmaceuticals to medicine to media, a lot of these sectors have still been relatively healthy in terms of job change, job growth, avoiding layoffs, and so forth. And it's not just the tech sector that makes up the entire labor market of the US. Does that make sense? The tech sector holds a lot of control in terms of capital and resources and the amount of money it makes, but it doesn't hold as much manpower compared to the other sectors as a whole, of course. Could the numbers have been pumped up a little bit more? Yeah, sure. Of course they could have. But I personally thought that the NFP and labor market data was going to be robust and optimistic anyways. And the reason why I thought this was Feds have been giving us signals about that themselves anyways. Even though some of the Fed comments and speeches may no longer hold as much market impact because it may not be new events, I still highly advise people to go read the newsroom during these Fed interviews or speeches, because they're still going to give you clues and signals of their inflation expectations, of their labor market expectations, of how they see consumer activity, of what they see going on in the real estate market. They still give you a lot of information and clues. It might not hold as much immediate market impact because it's not really anything new being brought to the table or anything new to price in, but it still gives you a lot of information and clues as stated. Right? Anyways, where were we? So the Bureau of Labor Statistics, they went back, they revised their data for December and for November. Of course, most market participants won't notice this change in the previous CPI releases. In fact, It is a solid plan to announce better numbers on release and then revise the numbers later down the line when market participants have rallied based on disinflationary data, right? He's talking about how the stock market was rallying based on everybody thinking inflation was dropping, right? That's the whole reason. They're hoping the Feds will pivot. And it diverted their attention to the next catalyst. We got these revisions after a month of the market using disinflationary numbers as the reason to front run a Fed pivot, right? And I highly advise to go through the rest of the report there as well. Okay. So anyways, the reason for that was that at that time, they were saying inflation was dropping. And it looks like I was actually right. It looks like my prediction of seeing January, February inflation rising, which would be reflecting for November, December, or January, if it's a February report, would be rising. It looks like I was right, and they actually manipulated the report and now came back and said, you know what? It was a high CPI still. Because the market would have been crashing. If we saw high CPI reports while price was sitting at pre-pandemic highs, and especially coming towards the end of the business year and killing a lot of the optimism into the holidays, man, we would have saw aggressive offloading of positions, going a straight dump to like 26K in the example of US 30. Right? So now that manipulation of data, that shifting of narrative to support the stock market buyers, to support market gains, and support a soft landing, not of the economy, but of the markets. Now, when the CPI report comes out high and we have Feds putting more pressure on the hawkish sentiment, all we're going to have is the stock market over the next week or two come back down to same low points and pre-pandemic highs we've already been adjusted to. Maybe starting to have a leg down after that, then retesting here and entering a bit of a bear market, maybe even through the rest of 2023, as we continue to watch how the data reports come out, looking at labor market reporting, consumer activity, CPI reports, and FOMCs. Right? So stock market buyers didn't want to let go of gains. They don't want to have a market crash. They want to create more market stability with equities, as their wealth is primarily tied to that. And they were heavily my Epic pen. And they were extremely used to the financial conditions that led to this huge pumping of the markets during the initial crash phase. They want this period to come back. Fed supporting the markets, continuing to pump the markets. That's what they want. But they're not going to get it because inflation is still high. Right? And of course, when you're looking at the dollar here, this extremely elevated upside in the dollar, right? Especially after the front loading of rate hikes here that went into 20 to 25 year historical highs on the dollar, right? It's not just watching dollar value go up, and as a manual retail trader, you're like, oh man, yeah, EURUSD sells, GU sells. These are real world financial markets, currencies of monstrous countries, right? That hold huge amounts of global power, economic sway, control, and so forth, right? This aggressive upside on the dollar, it wasn't just leading to some nice dollar buy plays for us. It was having a huge negative impact on smaller countries and their debt obligations, on emerging countries and their business profits and import and export profits, and even on larger countries and their currency value against the dollar on a global stage, as dollars a world reserve currency, right? We saw even major powerhouse countries during this phase, such as China doing currency intervention. Japan doing currency intervention. At the same time, they have a loose monetary policy going by the Bank of Japan. We saw Bank of England jump in and do bond buying amidst an active rate hike cycle just to help prop up their markets a little bit and slow down dollar domination, right? So what I'm trying to explain is having that correction towards the end of the year and setting up order flow for the new year. Now, if we see dollar domination come back into the scene with some high CPI reports, we're just going to be trending back to the highs. It might not even be in as aggressive fashion. And we're going to be going back to price points that global economies and markets have already seen before and have already been adjusted to. If dollar goes back into these highs, may we see some more currency interventions by countries? Of course we will. But we could at least expect to be driving back into these highs and filling that range and still maintaining some of that economic stability compared to dollar and compared to just having high CPI reports November, December, end of the year, and dollar would have just been surging straight still. Stock market would have been melting, dollar would have been surging. You would have had huge negative impacts on global economies, corporate and business profits being lost in the stock markets, and then countries' currency value being killed by dollar appreciating as well in an aggressive fashion. Does that make sense to everybody? So now we got some price and economic stability with dollar going back to highs we've already seen before. The economies have already been adjusted to, not just going to print and surge into new highs. And we have that price stability of the stock market, not just having a free-for-all crash. Yeah, it's going to, when we start to drop back down to these lows, they're going to start calling it a crash in the news. Oh man, stock market bears are back into play. Optimism is faded. Feds are putting the pressure on the fight on inflation. But the reality is we're going to be trending back down to lows and pre-pandemic highs we've already been adjusted to. It's not even close to the impact of being down here and starting to print new lows. Way more of a negative impact on corporate profits, business profits, global stock markets, and everything that's interconnected to that compared to this type of move. Does that make sense to everybody? On the combination of almost setting up order flow for the new year on both dollar and stock market and creating some of that price and economic stability across the board there too. Right? Yes, no, maybe so. So this is what they're talking about. Previous CPI, when we looked at the report, was minus 0%, minus 0.1%, and 0.3%. Both of those have been revised, right? Now they're expecting CPI for tomorrow. They already have projections of the monthly increasing and the core CPI yearly still being relatively a little bit more healthy on the core and on the CPI macro year over year here, right? They already have expectations that monthly inflation's increasing. If we see that CPI, and this is where it's going to become very interesting because previous CPIs have been revised, and these next monthly CPIs are already projected to be quite a bit higher. They're already giving that bit of buffer. They're already setting the market up saying, hey, yeah, we do expect inflation to be high this month as well, right? What we're going to need to see dollar domination come back into the scene is monthly CPIs either right on the forecast or higher, but more than that, we're going to need to see the yearly CPIs higher than forecast. If it's higher than previous, even better in bringing back dollar domination, right? Depending on the figures is also going to depend on the size of the impact to the charts. What do I mean by that? Well, let's just say we're describing gold movement here. I'm going to draw a gold diagram here. right? If CPI and what would be ideal is this coming out at like 0.5, this coming out at like 5.8, this coming out at like 0.6, and this coming out at like 6.6. Even with the revisions, even with the buffered forecast, inflation still being higher than forecast and the prior. This will lead to gold. This will lead to gold just straight melting or a very short liquidity grab and straight melting. If the inflation figures are below prior, but around the forecast and higher, right? Maybe something like, we'll come here in the orange. Maybe this stays the same as 0.4. This comes out right at 5.5. This comes out at 0.5. This comes out at 6.3. We're still going to have dollar domination, in my opinion, come into the scene, but more than likely a larger liquidity grab, then continuing down, or liquidity grab and going to the same lows and ranging. And then last but not least, this would be figures like here you come out at 0.3. This one might be 5.4. This one might be 0.4. This one maybe, let's just say, stays the same as 6.2. Now, because it's still showing declines or similar data to the prior, and it's within the buffered forecast expectations that the economists and market already expects, this would still be feeding more into the Fed pivot narrative and seeing a spike down on gold before turning more bullish. Does that make sense to everybody? Does that make sense to everybody? So maybe see something like that. And if it's lower CPI, you might see like a liquidity grab down and still bouncing after back into these ranges. Okay. Now that same type of ideology can be applied, like the same type of price movement and data expectations can be applied to GBPUSD, EURUSD, and US30. And then the inverse on USDCAD, obviously, as dollars the primary in that quote. So another quick example, if we're looking at current price points, and let's just say CPI is coming out in 10 minutes, and we're sitting here, this is what I would see the scenarios like. Buffered forecast just means they already have pretty strong expectations of inflation rising. So if it's within those expectations, it's not really a surprise. It can still be feeding Fed pivot prayer. What's the better word? This is my best dollar domination option, easiest impact. Main prediction. And then this same type of ideology in terms of price movement, impact, expectations would be very, very similar on GU. Very, very similar on EURUSD. Very, very similar on US30. and the inverse on USDCAD. Right? High inflation means the fight on inflation is not complete. Feds need to tighten financial conditions further, put more pressure on rate hikes and keeping rates up. Market begins pricing that in, which brings back dollar domination. Dollar bulls, gold bears, stock market bears. Fed pivot prayer narrative will only be supported with inflation still being low or still showing some declines, which will have the opposite market impact. That's the main focus point for the dollar pairs, gold, equities. That's the main information driving factor this week, on top of some of the Fed speakers and other data later in the week, which has been sent in the weekly flow. All right. Now, I'm going to save and upload this because now that I'm thinking about it, I don't really want to repeat myself during the market update webinar on YouTube tonight. So I'm probably just going to upload this to YouTube and then say it's a live stream tonight and just say, maybe some people will notice the time. But I'm going to save and upload this. I'm going to send another Zoom link in probably 10, 15 minutes after this saves. And we'll see if we get any scalps through the New York session, NYSE volume.